Welcome back to Set to Success. Let us start with the liquidity ratios, the MCQ on liquidity ratios. In liquidity ratios, we have 52 MCQs. So let us begin with doing all the 52 MCQs. So what here they are asking? Here they are asking about the acid test ratio or quick ratio. So what is acid test ratio? Acid test ratio or quick ratio. So what is acid test ratio or quick ratio? It is cash plus marketable securities plus accounts or receivable by current liabilities. So let us mark the quick assets first. Cash is your quick assets. Marketable securities is your quick assets. Accounts receivable is your quick assets. Inventory and prepaid expenses are not your quick assets. Accounts payable is your current liabilities, and long term debt, which is the current portion, that is your current liabilities. So total current liabilities is 75,000 plus 20,000, which is 95,000. And we have quick assets. So quick assets are 10,000 plus 18,000 plus 120,000, which is 148,000. So what we have done, we have taken the cash plus marketable securities plus accounts or receivable, that is 148,000, by the current liabilities, which is 95,000, and that is going to give you what we can say, that is going to give you the acid test ratio or quick ratio. So that is 1.56, which is option A. Yes, it's option A. Next. Given the acid test ratio here, acid test ratio is given. We have current assets 5,000 and inventory of 2,000. The value of current liabilities. So here we need to find out the value of current liabilities. So we have acid test ratio is 2, and we need to find the current liabilities, and quick asset is not given. We have current assets. Current assets are 5,000. Now current assets are 5,000 and inventory. So when we deduct inventory from your current assets, we are going to get the value of quick assets, because in in current assets, inventory and prepaid expenses are included, but in quick assets we don't include. So in order to find the quick assets, what we will do, we will take the current assets and we will deduct the inventory. So by deducting the inventory from your current assets, you are going to get the quick assets. What is your current assets? We have 5,000 and the inventory is 2,000. So your quick assets comes to 3,000. So now let us plug the numbers. So 3,000 is your quick assets, and we need to find the value of current liability. So current liability, by solving this equation, what will be the current liabilities? It will be two current liabilities is equal to that will be 3,000, and the current liabilities is equal to 3,000 by 2, and 3,000 by 2 is what we call it, it's 1,500, and it is 1,500. Next. So in this, what happened, what they need the cash ratio. So what is cash ratio? Cash ratio is cash plus marketable securities by current liabilities. So let us check what is cash and marketable securities. Cash and marketable securities, we have 200,000 and 100,000, which is 300,000, and by current liabilities. So what is your current liabilities? So total current liabilities is given. We have 600,000. So this is 300,000 by 600,000, which is 0.5 and which is option A. Next, this is one of the challenging MCQ and we need a wider space, so we'll come back to this MCQ after doing all other MCQs. So let us flag this MCQ so we can come back to it later on. Next, here they need the current liabilities. So what is given? We have quick assets, we have AC test ratio, we have current ratio, net sales, cost of sales, average total assets is given. So with the help of quick assets and AC test ratio, we are going to get the current liability. So in quick assets, we have 208,000 is your quick assets and AC test ratio or quick ratio is 2.6. Now, by solving this equation, we will get the current liability. So it's 2.6 CL is equal to 208,000 and what we call it, and the current liabilities is equal to 208,000 by 2.6, which is 80,000 and which is option B. Yes. Now question number 5 and question number 6 is the same, but here they need the inventory balance. So in here what we found out the current liabilities is 80,000. So let us plug the current liabilities first. So the current liabilities is 80,000. Quick asset was given 208,000 and the AC test ratio is 2.6. So here we have everything. So the current liabilities will come here as 80,000 and current ratio is given as 3.5. So it is 3.5. So now in order to find the current assets, no, it's not current assets, it's current ratio. So current ratio is given as 3.5. So now in order to find the current assets, by solving this equation we are going to get the value of current assets. So current assets is equal to 3.5 into 80,000. So 3.5 into 80,000 is 280,000. So current assets comes to 280,000. So now we have 280,000 as current assets. So the difference between current assets and quick assets will give you the value of inventory. And what they are asking here, they are asking the balance of inventory. Now, so 280 minus 208,000 is 72,000 and which is option A, 72,000. Next, a corporation has decided to include certain financial ratios in its year-end annual report to shareholders. Selected information relating to its most recent fiscal year is provided below. So we have cash, accounts receivable, we have prepaid expenses, inventory available for sale, securities, blah blah blah. And what do we need? We need quick or AC test ratio. So what is quick or AC test ratio? It is cash plus marketable securities plus accounts receivable by current liabilities. So let us mark the quick assets first. Cash is your quick assets, accounts receivable is your quick assets, prepaid expenses no, inventory no, available for sale securities will take at the fair value. At the cost, it's not taking at cost, it is taken at the fair value. And accounts payable is your current liabilities, notes payable that is due within 90 days. So this is also your current liabilities, and bonds payable no. So what is your current liabilities? Your current liabilities is 40,000, total of 15,000 plus 25,000, and now we have your quick assets. So what is total of your quick assets? So the quick assets are 10,000 plus 20,000 and the fair value, that is 12,000. So 10,000 plus 20,000 plus 12,000. So what it comes to, we have 42,000. So now 42,000 by 40,000 will give you 1.05, and which is option D. Yes, it's option D. Next. Here they need the current ratio. So let us mark what they need. They need the current ratio. So if they need the current ratio, we need current assets by current liability. So let us mark the current assets first. So accounts receivable is your current assets. Account receivable is your current assets, and cash is your current asset. Inventory is your current assets, and prepaid expense is your current assets. So we have 200,000 plus 200,000 plus 100,000 plus 400,000 plus 40,000. So that is your current assets. So current assets comes to 740,000 by your current liability. So what are your current liabilities? Accounts payable is your current liabilities, and the current liabilities. Interest payable is your current liabilities, and we have notes payable that is due in 6 months, that is also your current liability. So we have 80,000 current liabilities, plus we have 10,000, plus we have 50,000. So 80,000 plus 10,000 plus 50,000, so it's going to be 140,000. So we have 740,000 by 140,000, which is 5.28 5.2857. So which is, when we round off 5.2857, it comes to 5.29. Yes. Next they are asking about the acid test ratio or quick ratio. So what is acid test ratio or quick ratio? We know that the acid test ratio or quick ratio is cash, marketable securities, and accounts receivable by current liabilities, and that is your quick assets. So let us mark the quick assets first. Accounts receivable is your quick assets, cash is your quick assets, accounts payable, and that is your current liabilities, no. Interest payable is your current liabilities, no. Notes payable is your current liabilities, and prepaid expenses, no. So the quick assets are 300,000. The quick assets are 300,000 by the current liabilities. So current liabilities are 80 plus 10 plus 50, that is 140,000. So which is 300,000 by 140,000, which is 2.14, and which is option C. Next here they are asking about the acid test ratio or quick ratio. Let us mark the quick assets first. Cash is your quick assets, marketable securities is your quick assets, accounts receivable is your quick assets. We don't include inventory, we don't include the property plant equipment, and accounts payable is your current liabilities, accrued liabilities is your current liabilities, deferred taxes is not included in current liabilities, and seventh term, that is long term, not included. So they are asking for the end of the year. Okay, so end of the year is December 31st. So the current liabilities is 84,000 plus 11,000, 84,000 plus 11,000, which is 95,000. Now we have the quick assets. So cash, marketable securities, and accounts receivable. Cash, marketable securities plus accounts receivable is 144,000. by 95,000, which is 144,000 by 95,000, it is 1.5157. So which is rounded by rounding it off, we get 1.52, and which is option D. Next they are asking the current ratio. So we know what is current ratio. Current ratio is cash plus marketable securities plus accounts receivable plus inventory, prepaid expense, and by current liability. So let us mark the current assets first. So what is your current assets? Cash is your current assets, account receivable is your current assets, trading securities is your current assets, and inventory is your current assets. Property, plant and equipment, no. Accounts payable. Accounts payable is your current liabilities. Accrued liabilities is your current liabilities. So the current liabilities are 95,000, and the current assets. Current assets is 2,000 plus 47,000 uh, plus 47,000 plus 35,000 plus 138,000, which is 282,000 by 95,000. It is 282,000 by 95,000, which is 2.968, and which is 2. When we round it off, we get 2.97, and which is option D. Next, all of the following are included when calculating the AC test ratio except. So what is AC test ratio or quick ratio? See, 6-month treasury bill. 6 months treasury bill is marketable securities, and marketable securities are included in calculating the quick ratio. Prepaid insurance is not included in calculating the AC trust ratio, because prepaid insurance is included in your current assets while calculating. So we don't include the prepaid expenses. Now, accounts receivable is included in the quick ratio. 60 days certificate of deposit is cash equivalent, and cash equivalent is included, in calculating the AC test ratio, that is cash. So these three items are included, but we don't include the prepaid expenses. That's why that prepaid expenses is the correct option. There are two things: prepaid expenses, and we can call it as inventory. So these two items are not included. So maybe in the later I'm going to modify this MCQ by including the inventory, because inventory and prepaid expenses are not included in AC test ratio. Next, the company's cash ratio will decrease if the company purchases. So let us now understand what is going to happen. This is the effect of transaction. So here the best way is that you have to write the what we call it write the journals. So option A. What is option A? When you are purchasing the commercial paper, you are going to debit your marketable securities, or commercial paper marketable securities debit to cash. So this is cash ratio. So what happens, your cash is decreasing and your marketable securities is increasing. So there is no effect. By this we don't have any effect on the ratios. Now we have B. Now B, what is that? Purchase of materials on account. So when we are purchasing materials on account, we are going to debit your inventory, and we are going to credit because it's on account. So accounts payable will be credited. So cash ratio. So what happens? Your inventory and accounts payable. So you have your inventory. Inventory is not there, but accounts will. So your current liabilities will increase. So if your current liabilities is increasing by option D, what's going to happen? Your effect will be your ratio will decrease. by option B. Now we have sell goods for cash lower than the cost of sales. So when you are selling the goods for cash, so automatically what you are going to get, and the simple to understand is that you are going to get cash and your inventory is going to be credited. So we are not going into detail, but let us understand. So your cash will go up and your inventory is not there in the calculation, so overall the ratio is going to increase. So by this option the ratio will increase. Now fourth, receive cash by issuing short-term notes payable. So in this what happens now? What happens that you are receiving cash, that is option D. You are receiving cash by and you are crediting your accounts payable. So in this what happens, your cash is increasing as well as your accounts payable is increasing. So there is an equal increase, so the ratio can either increase or decrease. So the correct option they are asking for, the cash ratio will decrease. So the cash ratio is decreasing in option B. So this is how you have to do your MCQs by looking all the options. So this is the best way is that to look at the journal entries, and you have to know the formulas, you have to know the numerator, and you have to know the denominator. So that's why you can find out which is the correct option and which is incorrect option. Okay, next we have, in analyzing the short-term liquidity of a firm, many analysts prefer to use the acid test ratio or quick ratio rather than current ratio. The primary reason for this preference is that, see, why the analysts are using the current ratio, and they no why the analysts don't use the current ratio, but they prefer, the analysts prefer to use the quick ratio or acid test ratio, because in quick ratio your inventory and prepare expenses are included. Prepare expenses are expenses that are paid in advance, and inventory is something, an item that cannot be converted into cash easily, because your inventory can get obsolete, your inventory can be damaged. So that's why analysts, even if you are the analyst, so you will prefer your quick ratio or acid test ratio, which includes something that can be converted into cash within a short period of time on current liabilities. So quick ratio excludes accounts receivable. This is totally incorrect option, because accounts receivable is included in your quick ratio or acid test ratio, and accounts receivable is also included in current ratio. Current ratio includes marketable securities. Current ratio includes marketable securities, and quick ratio also includes marketable securities. So that's why this is incorrect option. If it is mispriced in the quick ratio, it will be mispriced in the current ratio as well. So both the ratio can be mispriced. Pro forma cash flow. Here we are not discussing about pro forma cash flow statement. Conversion of inventory into cash is less reliable. See what we have talked, the inventory. So there is a problem with the inventory. So conversion of inventory into cash is less reliable. That's why this is correct option. Next. This is one of the challenging MCQ, and we need a wider space, so we'll come back to it later on. Now let us proceed to other MCQs. Okay, now here we have, a corporation has 90 million in current assets. A corporation has 90 million in current assets. If the corporation has a current ratio of 1.2, quick ratio is 0.9, what is net working capital? So what is the net working capital? Net working capital is the difference between current assets and current liabilities. So the current assets are given as 19 million. Now we need current liability. So let us find out the current liabilities. So current assets are given, and the current ratio is given. So by using the current assets and current ratio, we can find out the value of current liabilities. So the current assets are 90 million, and the current ratio, which is 1.2. So what will be, by solving this equation, what will be your current liabilities? It will be 1.2 CL. 1.2 current liabilities is equal to 90. Current liabilities is equal to 90 by 1.2, and which is 75. Now the current assets was 90 and the current liability is 75. So 90 minus 75 equals to 15 million, which is option B. Next, a credit manager is considering whether to grant trade credit uh, to a new customers, and most likely to place primary emphasis on trade credit. Is you are granting a short term credit, you are deciding whether to grant the short term credit. So when you want to grant a short term credit, you are going to focus on liquidity ratios, because liquidity ratios measures the ability of a company to pay its short term obligations. So it is not profitability ratios, it's not valuation ratios, it's not growth ratios, it's liquidity ratios, which is the correct option. Next. Next, here we have a financial analyst has gathered the following selected financial data on three companies: Company A, Company B, and Company C. We have total current assets and total current liabilities on the basis of the information provided above. The financial analyst is able to conclude that. So for this here, current assets and current liabilities, for here only we can calculate the what we call the current ratio. So let us calculate the current ratio for each company's current ratio. So the current ratio for company A, we have current assets by current liabilities, we have 1.12, and for the company B we have 1.29, and for company C we have 1.4. So the current ratio is highest for the company C. It's the company C is the highest current ratio, and company B is having the lowest current ratio, and it's somewhat in the middle. So company A, company B have both higher liquidity than company C. No. Company B has the highest. Company B has the highest liquidity. Company B. No, it's company C. Okay, company A has the highest liquidity. No, company A has the lowest liquidity, because the company A is standing at 1.12. Now company B and company C. Company B and company C, it's 1.4 and 1.29, have higher liquidity than company A. See, 1.29 is higher than 1.12, and 1.4 is higher than 1.12. So that's why option C is correct option. A company has a current ratio of 2. Cash is 20%, accounts receivable is 40%, and inventory is 14% of total current assets. What is acid test ratio? So here they are asking the acid test ratio. So we know that acid test ratio is this. So now the current ratio is given as 2. So the current ratio is 2. Now cash is 20%, account receivable is 40%, and inventory is 40%. So let us assume certain numbers. 40% of total current assets. So let us assume that your total current assets is 100. So if your total current asset is 100, your cash is 20% of your total current assets. So cash is 20. Now we have AR, accounts receivable. Account receivable is 40. That means your account receivable is 40, and your inventory Inventory is 40. So total it's 100. And current asset is 100. So now they are asking your current assets are 100 and your current ratio is 100. So in order to find the acid test ratio, we need current liability. So let us find out the current liabilities first. So your the what is your current assets? Current assets are 100. So now by solving this equation, what we get, two current liabilities is equal to 100 and current liabilities is equal to 100 by 2, which is 50. So your current liabilities is 50. Let us plug the numbers. So we have current liabilities as 50 and your cash plus marketable securities plus accounts receivable. Cash, we don't have marketable securities, we have cash plus accounts receivable. So 20 plus 40, it's 60. So 60 by 50 is 1.2. So 1.2 must be the acid test ratio. Yes. So here they are asking about the company's net working capital. So what is net working capital? Net working capital is the difference between current assets and current liabilities. Now let us find the current assets and current liabilities. Cash is your current assets. Inventory is your current assets. Accounts receivable is your current assets. And what we call it, we have accrued wages is your current liabilities. Accrued wages is your current liabilities, and long term debt, no. Accounts payable is your current liability. So what is your total current assets and total current liabilities? So total current liabilities is 15,000. This is your total current liabilities, and your total current assets are 220,000, which is 160,000 plus 35,000 plus 25,000, 220,000. So 220,000 minus 50,000 minus 15,000, which is equal to 205,000, and which is option B. Next, here also we need to find out the net working capital. So let us find out the net working capital. So we have cash. If we have cash is your current assets, because net working capital, we know that net working capital is the difference between current assets and current liabilities. So we need cash is your current assets, account receivable is your current assets, inventory is your current assets, prepaid expenses is your current assets, property, plant and equipment, no. Intangibles, no. Now we have accounts payable. So let us mark the current liabilities. Accounts payable is your current liabilities. Notes payable is your current liabilities. Accrued expenses is your current liabilities. So your current liabilities are 208 plus 150 plus 50, which is 408. So your current liabilities are 408 minus your current assets. So what is your current assets? 110 plus 280 plus 125 plus 20. So what it is, it's 585. So it's 585 minus 408, 585 minus 408, which is 177. Option C. Next, a company located in China has reported on its first quarter balance sheet. First quarter balance sheet is 100,000 in cash, and accounts receivable we have 200,000 and 90,000 in current liabilities. The controller has forecasted that during the second quarter there will be no change in accounts receivable, but the cash balance will increase. Cash balance will increase by 5% and current liabilities will decrease by 10%. Based on the controller's forecast, the forecasted quick ratio, they need quick ratio for the second quarter. Based on the controller's forecast, what is the forecasted quick ratio for the second quarter? So what items do we have? We have cash, we have, let us mark, we have quarter 1 and we have quarter 2. We have items cash, we have accounts receivable, and we have current liabilities. For cash in quarter 1 we have 100,000. Accounts receivable we have 200,000, and the current liabilities are 90,000. Okay, now what happens in quarter 2? This cash is increased by 5%. If the cash is increased by 5% in quarter 2, the cash will be 105,000. Account receivable, there is no change in accounts receivable, that is 200,000 by 90,000. 90,000, there is a decrease in current liabilities by how much? By 10%. So if current liabilities is decreased by 10%, it's 81,000. So 105,000 plus 200,000 by 81,000, the quick ratio comes to 3.765, because they are asking for the second quarter on the basis of forecasted quick ratio. So forecasted quick ratio is 3.65. What is it? Is cash plus accounts receivable by current liability. So you know the formula that this is the formula that we have used, and it comes to 3.765, and when we round it off it comes to 3.77, and which is option D. Next, a company has current liabilities of 2 million and net working capital of 3. Net working capital is 300,000. If the company has a quick ratio of 0.8, the company has an inventory of. So here what we are going to do, first we are going to find out the current assets, because they are asking the value of inventory. And here working capital is given, current liabilities are given quick ratio. So we can find out the value of quick ratio. Basically we need to find out the value of current assets and quick assets. The difference between current assets and quick assets will give you your inventory. So current assets value can be found out by the net working capital. So net working capital is they have given us 300,000. What is your current assets? Current asset is not given, but current liabilities are given. So current liabilities are 2 million. So 2 million, so the current assets will be 2.3 million. So we got current assets as 2.3 million. Now we need the quick assets. Now the quick ratio is 0.8. So what is your quick ratio? Quick ratio is 0.8, and your current liabilities, we have the current liabilities, right? The current liabilities are 2 million. So the value of quick asset is 0.8 into 2 million. So 0.8 into 2 million, it's 1.6 million. So the quick assets are 1.6 million. Now the difference between the current assets and quick assets is your what we call it is your inventory. and that comes to 700,000, which is option B, 700,000. Yeah. Next, North Bank is analyzing Bellis Corporation financial statements for a possible extension of credit. Bellis quick ratio is significantly better than the industry average, which one of the following factors should not consider as a possible limitations of using this ratio when evaluating Bellis creditworthiness. So, fluctuating market price for the short term. See, what they are focusing on. They are focusing on quick ratio. So, what is quick ratio? Quick ratio is cash plus marketable securities plus accounts receivable by current liabilities. So, fluctuating inventory price for short-term investment may adversely affect the ratio, because marketable securities is included, and this is correct option. But if there is a fluctuation in the market price, that is going to affect your quick ratio, because marketable securities is included while calculating the quick ratio. Increasing the market value for inventory. See, inventory, what happens? Inventory is not included in the quick ratio, so this becomes the incorrect option. That is not going to affect your quick ratio because we don't include. Bellies may need to sell its available for sale securities. Available for sale securities are also not included while calculating the quick ratio. Belly may need to liquidate inventory. See, again, inventory is not included in calculating the quick ratio. So the correct option is that we include the marketable securities, short-term investments. So that's why it is going to affect and not consider possible limitations. So North must consider possible limitation using the ratio while evaluating Belli's worthiness, that marketable securities marketable securities can fluctuate. It can go down or it can go up. Next you have in comparing the ratios of two companies, why it is invalid to assume that the company with the higher current ratio is better company. So they're asking that why it is invalid to assume that the company with the higher current ratio is the better company. The current ratio includes assets other than cash. The current ratio includes assets other than cash. This is correct option because the current ratio includes other assets other than cash, because we have cash, marketable securities, accounts receivable, inventory, and prepaid expenses. A high current ratio may indicate inadequate inventory on hand. So a high current ratio, no, because we are using many other things. Many other things are included in the numerator, so that's why this is not the correct option. A high current ratio may indicate inefficient use of various assets and liabilities. So this is correct option, because a high current ratio may indicate, if you have a high current ratio, this means you are inefficient in using your assets and your current liabilities, current assets and current liabilities. Two companies may define working capital. This is wrong statement, because working capital is a term which is the difference between current assets and current liabilities. So one company cannot define working capital as they wish, the other company cannot define the working capital as they wish. So the correct option is that a current ratio may indicate inefficient use of various assets and liabilities. Next, a company uses the allowance method. This is also one of the difficult questions, so let us flag this question and we'll come back to it later on. So we have questions are left. Okay, a company has current assets of 400,000, current liabilities of 500,000. The company's ratio will increase by. So here we have to go to the journal entries in order to analyze. So the purchase of 100,000 of inventory on account. So option A, purchase of 100,000 of inventory on account. So what is journal entry? You are going to debit your inventory and you are going to credit accounts payable. So current ratio, they're asking about the current ratio. So current ratio, what happens, your inventory increases, your accounts payable increases. So first let us see what is your current ratio. So current ratio is equal to current assets by current liabilities, 400 by 5000, and your current ratio is less than 1. So less than, what happens, if the equal increase will increase the ratio. Why? Because the ratio, if the ratio is less than 1, what is going to happen? It is the same. The equal increase in both the numerator and the denominator. Equal increase in both the numerator and the denominator will, what will be the effect? It will increase the ratio. In the first case, the ratio is increasing. In the second case, what is happening? The payment of 100,000 of accounts payable. So when you pay your accounts payable, you are going to debit your accounts payable and you are going to credit your cash. So in the second case, what happens to the current ratio? Your accounts payable, this means your current liabilities decreases and your cash also decreases because you are paying, right? Your current liabilities decreases and your cash decreases. So in this case, what happens, if there is an equal decrease in both the numerator and the denominator, the ratio will decrease. So in this, the ratio is decreasing. So let us mark here, the ratio increases, here the ratio decreases. Now let us see the option C. What is happening with the option C? The collections of hundred thousands of accounts receivable. So when you are collecting collection of hundred thousands of accounts, so when you are collecting, what you are doing, what you are getting, you are getting cash and you are debiting cash and you are crediting accounts receivable. So both the items are in the numerator of the current ratio, cash and accounts receivable. So this what happens, your account receivable is converted into cash. So they basically, there is no effect by this, the collections of accounts, the collections of hundred thousands of accounts. So there is no effect. So last we have refinancing of 100,000 long term debt with the short term. So in this what we do, in option D, we are going to pass a entry that is long term loan debit to short term. So in this, what happens, basically your short term, your current liabilities is increasing. So if your current liability is increasing, this is going to decrease the ratio because your denominator increases. So what they are asking, increase. So there is only one option that is going to increase your ratio, that is option A, because your ratio is less than 1 and there is an equal increase in both the numerator and the denominator. You're purchasing inventory, so your inventory is increasing and your accounts payable is increasing. So if both increases, if the ratio is less than 1, an equal increase in both the numerator and the denominator will increase the ratio. So that's why option A is the correct option. Next, has 2 to 1 current ratio. The ratio would increase to more than 2 to 1 if a previously declared stock dividend were distributed. So there is no relation of stock dividends. So a stock dividend does not affect your current ratio. The company's write-off and accounts receivable, that is not going to affect your current ratio. The company purchased inventory on account. So when you are purchasing inventory on account, what you are going to do, you are going to debit your inventory and you are going to credit your cash. So when you are going to debit your inventory and crediting cash means what? It's open account, it's not cash, it's accounts payable. Okay, so your inventory is increasing and your current liability is increasing. So if your ratio, and here the current ratio is 2, so the current ratio is greater than 1. So if the ratio is greater than 1, An equal increase in both the numerator and the denominator will decrease the ratio. So here the ratio decreases. Now option C is what? The company sold merchandise on open account that earn a normal gross margin. So they are selling an open account. This means we have a receivable, accounts receivable, and you are selling inventory. So here what happens, your accounts receivable, your inventory is converted into accounts receivable. So if your inventory is 100,000, so you are not going to sell at 100,000. So there is a profit margin, right? So maybe the profit margin is 20%, 30%. So accounts receivable will be 130,000, right? If your inventory is 100,000, you will get some percentage and you will sell for 100. So you are converting your inventory of 100,000 to 130,000, which indirectly will increase the ratio from 2 to more than 2. So that's why this is the correct option. Next. Genesis Solution is a manufacturer of industrial products that uses a calendar year for financial reporting purposes. Assume that the total quick assets exceeded total current liabilities both before and after the transaction described. Further, assume that the Genesis has positive profits during the year and a credit balance throughout the year in its retained earnings account. Genesis payment of trade accounts payable of 64,500. So, first let us understand what is your quick ratio or current ratio. Assume that your total quick assets exceeded total current liabilities both before and after the transaction described. This means your current ratio is greater than 1 and your quick ratio is greater than 1. So the current ratio and quick ratio, if it is greater than 1, the opposite is going to, it will have an opposite effect. This means an equal increase in both the numerator and the denominator will decrease the ratio. An equal decrease in both the numerator and the denominator will increase the ratio. So Genesis payment of trade accounts payable of 64,500. So when you are paying trade accounts payable, you are going to debit your accounts payable by you are going to debit your accounts payable by 64,500 and you are going to credit your cash by 64,500. This means what, you are decreasing your cash as well as you are decreasing your current liabilities in current ratio. This means equal decrease will increase the ratio. So by this transaction, what is going to happen, your current ratio is going to decrease, and same thing is going to happen here. Your current liabilities decreases and your cash is also decreasing. This means this will increase the quick ratio or acid test ratio as well. So the correct options that increases both the current and quick ratio, increases both the current ratio and quick ratio. Next. Genesis purchases of raw material for 85,000 on an open account. So when you are going to purchase raw material for 85,000, so you are going to debit the inventory account. So here the inventory account is debited by 85,000 and you are going to credit your accounts payable because it's an open account. So accounts payable is credited by 85,000. This means what? Yeah, this means your inventory account. So this means your inventory is increasing and your current liabilities is increasing. If your inventory is increasing and current liabilities increase, this means this current ratio will decrease. And inventory and accounts payable. So inventory is not included in your quick ratio or acid test ratio. So quick ratio, what happens? Accounts payable and current liabilities will increase. So if it's increasing, this means this is going to decrease the ratio. Now they're asking about the working capital. So working capital is the difference between current assets and current liabilities. So here what happens, your current assets increases and your current liabilities increasing, so both is increasing, so net working capital will have no effect. So increases net working capital, decreases net working capital will have no effect, but your current ratio will decrease, right? Your current ratio will decrease because mm, because an equal increase in both the numerator and the denominator will decrease the ratio. Next, a collections of accounts receivable. So when you are collecting accounts receivable, what is going to happen, you are going to get cash. So you are going to debit cash accounts by 29,000 and you are going to credit your accounts receivable by 29,000. So here what happens, here you are going here here what happens, your accounts receivable 29,000 is converted into cash. So there is no effect on the numerator, there is no effect in the denominator. This means current ratio, there will be no effect on current ratio. And what will be the effect on quick ratio or acid test ratio? The same thing, that your accounts receivable is you converted into cash. This means there will be no effect on your quick ratio or acid test ratio. No effect. Next. Next we have obsolete inventory. Obsolete inventory was written off by Genesis during the year this transaction. So we have an obsolete inventory. So what accounting entry do we pass? That is, you are going to debit your loss. That is by 125,000 and you are going to credit your inventory by 125,000. So this is quick ratio and current ratio. So what has happened, your inventory is decreasing. So if your inventory is decreasing, this means your current ratio will decrease. Your current ratio will decrease and your current ratio decreases. Okay, increases the net working capital. So net working capital, your inventory, your current assets decreases. If the current assets decreases, this means your net working capital is not going to increase, it's going to decrease. Increase the quick ratio. See, it's inventory, right? So inventory, we don't have the inventory is not included while calculating or quick ratio, acid test ratio. So it is increase or decrease, it will have no effect because decreased and increased, so there is no effect, right? Because inventory is an item that is not included in your quick ratio or acid test ratio. So the correct option is decreases the current ratio, because your inventory is decreasing, this in turn decreases your current ratio. Next, Genesis early liquidations of long-term note with cash. So if you are doing early liquidations, what entry do you pass? It's you are going to debit long-term notes payable by cash. So in this, what happened, your long-term notes payable by cash. So here they are asking the current ratio to a greater degree than the quick ratio, or quick ratio to a greater degree than the current ratio. So in current ratio, what have the current ratio, in the current ratio, the numerator is a huge amount. And the current liabilities remains the same for current ratio and the quick ratio, and here the numerator is less. So you are decreasing cash, right? So if you are decreasing cash, so your cash goes down and your current ratio cash also goes down. So the effect on current ratio will be much more lower, and here the effect will be higher. So let us see. Quick ratio to a greater degree than the current ratio. So quick ratio will be impacted at a greater degree than the current ratio because it's because of the numerator. Next. A corporation has a current ratio of 2 to 1 and the quick ratio of 1 to 1. A transaction that would change the quick ratio but not the current ratio. So if they are asking the difference between quick ratio and the current ratio. So current ratio and quick ratio, what is the difference between these two? Inventory and prepaid expenses. Sale of inventory, correct option, because the inventory is included while calculating the current ratio is not included. Collection of accounts receivable, if you are collecting the accounts receivable, what is going to happen? It is included in your quick ratio as well as it is included in your current ratio. So that's why this is the incorrect option, because they are asking the difference. Payments of accounts payable, if you are paying your accounts payable, what is going to happen? It is going to impact your current ratio and quick ratio. That's why this is the incorrect option. Purchase of patent for cash, if you are purchasing patent for cash, it is going to have an effect on both the sides. That's why this is also the incorrect option. Next, because they are asking the difference between the quick ratio and current ratio, the difference between these two is inventory and prepaid expense. That's why inventory is the correct option. Next, this is one of the challenging and difficult MCQ, so we'll come back to it later on. So we have two MCQ related to this question. So now let us proceed to the next MCQ. 37, we have the following transactions occurred. The following transaction occurred during a company's first year of operations. We have purchased a delivery van for cash, borrowed money by the issuance short-term capital, and purchase treasury stocks. Which one of the following have caused a change in the amount of working capital? So what is working capital? So working capital is the difference between current assets and current liabilities. So when you are purchasing delivery van for cash, what entry do you pass for first? You are going to debit your delivery van and you are going to credit the cash. So your cash is decreasing, right? If the cash decreases, your current assets decreases. So what is change in the work? So this one is going to change, one is going to affect your net working capital. Now let us see the second option. Second option is that borrowed money by the issuance of short-term debt. So when you are borrowing money by the issuance of short-term debt, that means you are going to debit your cash and you are going to credit your short-term debt. This transaction, what happens? This transaction increases your current assets and this transaction increases your current liabilities. And it's the difference. The net working capital is the difference between current assets and current liabilities. If your current assets increases and your current liabilities increases, this will have no effect on your working capital. Purchase of treasury stock. So let us see, when you are purchasing the treasury stock, so what is going to happen? You are going to get your treasury stock debit and you are crediting your cash. So cash is going to decrease. So if the cash is decreasing, this means your current assets decreasing. This will have an effect on net working capital. But borrowed by the issuance of short-term debt, this will have no effect on your working capital. So we are left with option 1 and 3. So 1 and 3 only. Next. So this optimum enterprises have the following account information is given. What will happen to the ratios if Optimus uses cash to pay 50% of accounts payable? So now let us find out. Find out the current ratio and quick ratio. So let us have a big area to do the calculation. So we have the current ratio and the quick ratio. So what is current ratio? So let us mark the current assets first. Account receivable is your current assets. Bonds payable due in 10 years, no. Cash is your current assets. Inventory is your current assets. Prepaid expenses is your current assets. So what is your current liability? So the current liabilities are notes payable due in 6 months, that is your current liabilities. Interest payable due in 3 months, that is your current liabilities. And bonds payable, no. Accounts payable is your current liability. So the current liabilities are 80,000 plus 10,000 plus 50,000. So it's around, the current liabilities are, so the current liabilities are 140,000. So the current assets, so the current assets are 200,000 plus 100,000 plus 400,000, 740,000. So the current assets are 740,000. Now let us know what is your quick assets. So the quick assets are, inventory is not included in your quick assets. So quick assets are, account receivable is your quick assets, cash is your quick assets, cash is your quick. So we have 300,000. So the quick assets are 300,000. Now let us calculate the ratio. So current ratio, so the current ratio is current assets by current liabilities. So that is 740,000 by, we have 140,000, which is 5.28, and 5.28 is, that means the current ratio is greater than 1. Now let us find out the quick ratio. So quick ratio is quick assets by current liability. So what is your quick assets? Is 300,000 by your current liabilities. So current liabilities are 140,000. So quick assets 300,000 by 140,000, that is 2.14. So the quick ratio is also greater than 1. So if the ratio is greater than 1, so what transaction the Optimum enterprise doing? That cash to pay 50% of accounts payable. So in the numerator the cash is decreasing, and if the cash is and the accounts payable, 50% of accounts payable is decreasing. So equal decrease will, what happen, it will decrease, equal decrease in both the numerator and the denominator will increase the ratio, we know this. So the current ratio is greater than 1 and the quick ratio is greater than 1, so both the ratio will increase because there is equal decrease in the numerator and equal decrease in the denominator as well. So that's why the ratio is going to increase. Yeah. Now we have next what do we have? So let us open the PDF. So all of the flowing are affected when merchandise is purchased on credit. So when you are purchasing merchandise on credit, what is going to happen? You're going to debit your inventory and you are going to credit accounts payable. So total current assets. So total current assets will be impacted because your inventory is you are purchasing inventory. So inventory is increasing, so your total current assets will increase. Net working capital. So net working capital is the difference between current assets and current liabilities. So here what happens, your current assets increases, your accounts payable is your current liabilities which increases. So both is increasing, so the net working capital will have no effect. Total current liabilities, accounts payable is increasing, so total current liabilities increasing. Current ratio is to current assets by current liabilities, so there will be an effect on current ratio as well. So all of the things affected when merchandise is purchased on credit except the net working capital. Next, and next we have an entity has total assets. Okay, how much is left? Okay, an entity has total assets of 7.5 million and the current ratio is greater than, the current ratio is 2.3. So this means the current ratio is greater than 1. So greater than, before purchasing 750,000 of merchandise on credit for sale. After this purchase, the current ratio will. So the current ratio, we know that the current ratio is greater than 1. So let us pass the inventory. Let us pass the journal entry. So when you are, what happened when, before purchasing merchandise on credit? So when you are purchasing merchandise on credit, what entry do you pass? You are going to debit your inventory account, and you are going to credit accounts payable by 750,000. So this means what, your numerator is increasing and as well as your denominator is increasing, and the ratio is greater than 1. So if the ratio is greater than 1 in the opposite direction, this means the equal increase in both the numerator and the denominator will, what happen, will decrease the ratio. The ratio will be lower than 2.3. Next, the allowance for credit losses increase. See, if your allowances for credit loss is increased, this will this transaction what this transaction is going to decrease your accounts receivable. So accounts receivable decreases. If your accounts receivable decreases, this means it will reduce your current ratio, because your accounts receivable is decreasing, and if accounts receivable is decreasing, the current ratio is going to decrease. It will have an impact on the current ratio. Next, a firm must increase its acid test ratio above the current ratio 0.9 in order to comply with the terms of loan agreement. Which one of the following action is most likely to produce the desired result? So they are asking about the acid test ratio, and the ratio is less than 1. So we are standing at here. So what they are asking, which one of the following action is likely to produce the desired result above the current? So you have to increase the ratio, right? So you have to increase the ratio. This means you are going to an equal increase in both the numerator and the denominator will increase the ratio. See, collections of accounts receivable. So when you are collecting accounts receivable, what is going to happen? Your AR is converted into cash. So here there is no effect. Making payment to trade accounts payable. So when you are making the payment to trade accounts payable, so your when you are making the payment, this means the third one, there is an increase making payment to trade accounts payable. So when you are making the payment to trade accounts payable, there is a decrease in the numerator, and trade accounts payable, there is decrease in the denominator as well. So both is decreasing. So equal decrease in both the numerator and the denominator, what is going to happen? It will decrease the ratio. So by this, the ratio is going to decrease because they are making payment. We are using cash to trade accounts payable. Purchasing marketable securities for cash. So if you are purchasing marketable securities for cash, so here what your marketable securities, you are changing marketable securities to cash. So here also we don't have any effect. Selling auto parts on account. Selling auto parts on account, this means you are getting cash and your inventory is going out. And inventory is not included while calculating the quick ratio or acid test ratio. That's why if you are increasing your cash, this means your cash is increasing. So this will increase your acid test ratio or quick ratio, and we need acid test ratio to go above 0.99 level. So this is the correct option which will increase your quick or acid test ratio. Next, the owner of a chain of grocery stores has bought a large supply of mangoes and paid for the fruit with cash. The purchase will adversely impact which one of the following? So what they have done, the merchandiser or whatever they have purchased mangoes and they have paid it with cash. Mangoes, fruit. Okay, so they have made a cash payment. So which one of the flowing with which one of the flowing adversely impact which one of the okay, the purchase will adversely impact which one of the flowing? Working capital. See, working capital is the difference between current assets and current liabilities. So you are changing your current assets, so there will be no impact on working capital. acid test acid test quick or acid test ratio. So acid test ratio, what happens, your cash is decreasing and we don't include mangoes is inventory. So inventory is not included while calculating the quick ratio acid test ratio. This what happens, this is not going to impact your, this is going to impact your uh, quick or acid test ratio. This will decrease your acid test ratio because the cash is decreasing. Price earning, we are not discussing price earning ratio here. Current ratio, let us see what happens to the current ratio. Okay, the current ratio is that you in current ratio, what we are doing, we are converting our cash to inventory. So there is no change, so current ratio is not going to change. So the ratio that is going to be impacted by this transaction is quick ratio or acid test ratio. Next, both the current ratio and the quick ratio for Spartan corporations has been slowly decreasing. For the past 2 years, the current ratio was 2.3 and it was 2. During the same time period, the quick ratio has decreased from 1.2 to 1. The disparity between the current ratio and a quick ratio is explained by which one of the following? See, the disparity between the current ratio or quick ratio is your inventory and prepaid expenses. Inventory balance is usually high. So whatever the question like this, the comparison is given, the comparison will be of the inventory or the prepaid expenses. Next, the acid test ratio shows the abilities of a company to pay its current liabilities without having to liquidate its inventory, because because inventory is not included while calculating quick ratio or acid test ratio. If a company has current ratio of 2.1 and pays off a portion of accounts payable with cash, so the ratio is greater than 1 if it's suppose accounts receivable with cash pays off accounts receivable with cash, accounts well, sorry, accounts well. So what entry do we pass? So the entry that is going to the entry that we pass, that accounts payable is debited and your cash is credited. So so in the numerator, the ratio is, current ratio is greater than 1. So what happens, you are decreasing your numerator and you are also decreasing your denominator. So equal decrease in both the numerator and the denominator will increase the ratio. See, If the ratio is greater than 1, here the ratio is greater than 1, so the entry is that pays off a portion of accounts payable with cash. So accounts payable is decreasing, your current liabilities is decreasing, your cash is decreasing. So equal decrease in both the numerator and the denominator will increase the ratio. So it will increase the ratio. Next, now what is this? A condense. Okay, for this we need a little space, so let us close the PDF and let us do this MCQ. So a condensed comparative balance sheet for the companies for the company appears below. So we have certain items are given. So what they are asking, in looking at the liquidity ratios at the both financial statements, what happened to the current ratio and AC test ratio? So we have to calculate the current ratio and quick ratio for year 1 as well as for year 2. So we have a current ratio for year 1 as well as for year 2. So let us mark the current assets first. Cash is your current assets, account receivable is your current assets, inventory is your current assets. And the current liabilities are given. Now what is your quick assets? So your quick assets is cash is your quick assets and account receivable is your quick assets. So let us calculate current ratio for year 1 as well as year 2. So the current ratio, so for the current ratio it's we have 40 plus 120 plus 200, it's 360,000 by 60,000, which is 6. And for year 2 we have 430,000 by the current liabilities, which is 100,000. So the current ratio for year 2 is 4.3. So what happens, from the current ratio from 6 it has decreased to 4.3. So the current ratio is decreased. So now let us do for the quick ratio for year 1 and for year 2. So quick ratio. So what is quick ratio? We have cash and accounts receivable. So we have 160,000 for year 1 by we have 60,000, that is 2.67, and for year 2 we have what we call it, we have 130,000 by 100,000, which is 1.3. So what happens, the current ratio is decreased as well as the quick ratio from 2.67 it has decreased to 1.13. So current ratio has decreased and your quick ratio has decreased, sorry. Your current ratio has decreased and your your quick ratio your quick ratio okay, your quick ratio has decreased from 2.67 to 1.3, and your current ratio has decreased from 6 to 4.3. So current ratio has decreased and your acid test ratio has, no, both is decreased, right? Yeah, both is decreased. So the correct option is option D. Next, The firm has the following current assets and we have current liabilities. So what is your current ratio or quick ratio? So let us calculate the current ratio. So current ratio, we know that the current ratio is greater than 1 and your quick ratio is also greater than 1. So let us see. The current ratio will decrease if the payment of 100,000 cash is used to pay 100,000 of accounts payable. So current ratio will decrease if the payments of 100,000. So in the current ratio, cash is decreasing and used to pay 100,000 of accounts payable. So your current liabilities decreases, and the ratio is greater than 1. So an equal decrease. Wait a second. So your cash is decreasing and your accounts payable is decreasing. So if accounts payable is decreasing, the equal decrease in both the numerator and the denominator will increase the ratio. So the current ratio here will not decrease, it will increase. Now current ratio will not change. No, current ratio is going to increase. Acid test ratio will decrease if the payment of acid test ratio will decrease. So this we'll discuss later on. Let us see. Acid test ratio will not change if the payment of 100,000 cash is purchased. Let's see, it will decrease because what happens to inventory is not included while calculating your acid test ratio, but payment of 100,000 cash. So your cash is decreasing. So if the cash is decreasing, the ratio is going to decrease. So this will decrease the ratio, and acid test ratio will decrease if the payment of 100,000. Yes, this is the correct option, because if you are going to, if a payment of 100,000 cash is used to purchase inventory, this will decrease the acid test ratio or quick ratio. Next. A company has 80 million in current assets comprised of 30 million in inventory and 15 million in cash and marketable securities. The company's current liabilities total 50 million, and if the company purchases an additional 10 million in inventory with 10 million in cash. So the company is going to purchase the inventory and cash. So what entry do we pass? We are going to debit the inventory account, the cash, and the amount is $10 million. So by this transaction, what is going to happen? Your inventory is converted into cash, or cash is converted into inventory. So what you are doing, you are converting your inventory into cash. So there is no impact on the current ratio, but quick ratio, what happens? You are decreasing your cash, but there is no inventory. So this means your quick ratio will decrease, but there will be no change in the current ratio. So decreases the quick ratio. This is correct option because it will decrease the quick ratio and the current ratio remains unchanged. Next, let us close the PDF because we need larger calculation for this. So we have during the current year a corporation A had 100,000 shares of common stock outstanding. On July 1st, the corporation issued 4-to-1 stock split. So there is a 4-to-1 stock split. Additionally, on September 2, declared a dividend of 0.5 per share. So 0.5% per share dividend is declared, and the payment is expected to be made on Jan of the following year. If A had current assets of 2 million and the current liabilities of 1.2 million before the declaration of the stock dividend, what percentage change in the current assets as a result of the dividend declaration? So current ratio before declaration and after declaration. So we need to compare both the ratios and we need to find the percentage change. So current ratio before declaration So what is current ratio before declaration? We have current assets by current liabilities. So current ratio is equal to current assets by current liabilities, and the current asset is 2 million and 1.2 million. So it's by 1.2 million, which is 1.67. Now current ratio after declaration. So when you are going to declare dividend, what you are going to, you have 100,000 of common share outstanding, and there is a stock split. So 100,000 into 4. Now we have 400,000 shares. On that 400,000 shares, what we are doing, we are paying 0.5 per share as dividend, 0.75. So 400,000 by 0.75, which is 300,000. So on the date of declaration, what we do, we pass an entry, that is retained earnings account is debited and dividends payable account is credited. By how much? It's by 300,000. So this, your accounts payable, your current liabilities is increasing by 300,000. So now the current liabilities and the current assets was the current assets was 2 million. The current assets remains the same, but there is a change in your current liability. So before uh, it's 2 million, right? Okay. So before the current liabilities was 1.2, now the current liabilities has increased by 300,000. So 1.5 million. So if it is 1.5 million, so the current ratio after declaration comes to be 1.33. Now here they are asking about the percentage change. So now let us calculate the percentage change. So percentage change is changed by original into 100. So what is change? 1.33 minus 1.67. So it is 1.33 minus 1.67 by 1.67 into 100. So this will give you a percentage change of 20.35, and which is 20% decrease. Next, at the beginning of the year, company C had the following items on its balance sheet. The items are given. During the course of the year, C declared and paid dividends $1 per share. Assuming that the dividends payment is only the transaction in the year, what is the percentage change for the quick ratio as a result of dividends? So they are asking the percentage change in the quick ratio. So first, let us calculate the quick ratio before payment, before dividend payment. So quick ratio before dividend payment, QR after dividend payment. So let us mark the quick assets first. cash is your quick assets, marketable securities is your quick assets, inventory no, prepaid expense, inventory no, prepaid assets no, net account receivable is your quick assets. So quick ratio is equal to quick assets by current liability. So your quick assets are 100,000, 70 and 30. 100,000, 70, 100,000, 100,000, 30 and 70 gives you 200,000. So your quick assets are 200,000 and your current liabilities are 125,000. So your quick ratio comes to 1.6. Now quick ratio after dividend declaration. So what happens? Your quick ratio is equal to quick assets by current liabilities. Now 40,000 you have C declared and paid dividends 1%, 40,000. So you have 40,000 shares and you have paid $1 per share, so that is equal to 40,000. So when you pay the dividend, so what entry, when you pay a dividend, so what entry do you pass? The entry that is debited in the books of accounts is dividend payable. Dividend payables account debit to cash by 40,000 because 40,000 you're paying. So this happens, the cash is decreasing. This means your quick assets will decrease by 40,000 and your current liabilities will also decrease by 40,000 because you are paying, right? Now the ratio, if the quick assets is 200,000, so 200 minus 40,000, that is 160,000 by 85,000. Now 160,000 by 85,000 is 1.88. So quick ratio before dividend payment was 1.6 and quick ratio after dividend payment is 1.8. So they are asking about the percentage change. So percentage change, we know that it's change by original into 100. So what is the change? The change is 1.6 minus 1.88 by 1.88 multiplied by 100. By solving this equation, you are going to get a 20% decrease in the quick ratio. Next, when reviewing a credit application, the credit manager should be most concerned with the applicant working capital and current ratio, yes, return on capital, no, price earning ratio, no, profit margin, return on assets, no. So we only have to focus on the liquidity ratios, and the liquidity ratios are working capital and the current ratio. Working capital and current ratio, which is the correct option. So what we have left? So we are left with question number 4. So let us now find out what they need. A company has current ratio of 1.4 and acid trust ratio of 1.2. And the following partial summary of balance sheet is given. We have cash, account receivable, inventory, fixed assets and total assets. If the total asset is 100, if the total assets are 100, your total liabilities also will be 100. And if your total liabilities and equity are 100, your current liabilities will be 30. Now let us find the accounts receivable. So quick ratio is equal to cash plus accounts receivable by the current liabilities. So by the current liability. So cash we have 10, we don't have AR, so by this we can find out the value of AR, and the current liabilities is 30 and the quick ratio is given as 1.4. So 1.4 into 30 is equal to 10 plus AR, and the AR is equal to 26. Now we found out the value of accounts receivable. Now let us find out the value of inventory. So the value of inventory can be found out by the current ratio. So current ratio is equal to cash plus AR plus inventory by current liabilities. So what is your cash? Your cash is 10, account receivable we have 26, and we don't have inventory. By current liabilities, which is 30, and your current ratio of 1.4. A company has current ratio of 1.4, a quick or acid test ratio of 1.2. So a current ratio is 1.4 and the quick ratio is 1.2. The flowing partial balance sheet is given, so we need to find the value of accounts receivable. So let us find the value of everything. So if your total asset is 100, your total liabilities and equity will be 100. Okay, when your total liabilities and equity is 100, your current liabilities will be 30, because 30 plus 40 plus 30 is equal to 100. Now let us find with the value of let us find by using the acid test ratio the accounts receivable. So quick ratio is equal to cash plus AR by current liabilities. Cash is 10 plus AR, and current liabilities we found out to be 30, and the quick ratio is 1.2. So 1.2 into 30 is equal to 10 plus AR, and by solving this equation AR is equal to 26. Now current ratio. So current ratio is equal to cash plus accounts receivable plus inventory by current liabilities. So the current ratio we have 1.4, and the current liabilities we know it's 30. The cash is 10 plus AR we found out to be 26. We don't know inventory, so we can find out the value of inventory from here. So 1.4 into 30 is equal to 10 plus 26 plus inventory. So by solving this in this equation, the value of inventory comes to 6. Now the value of inventory is 6, the account receivable is 26. Now by this we can find out the value of fixed assets. So fixed assets, the value of fixed assets are 58. So now here they are asking about accounts receivable. So accounts receivable we have 26. So in this question they can ask anything. They can ask your inventory, they can ask your fixed assets, they can ask your current liability, so they can ask anything. So that's why I have calculated every figure by this. Now we have question number 15. So what it is, question number 15. So let us now read the MCQ. A firm has gathered financial statements data. A firm has gathered financial statements data for 3 companies applying for credit as new customers. The company extends credit to customers on the credit terms 2, 10 and net 30 prior to accepting the customers. A financial analyst with the firm performs liquidity analysis summary. So they are performing the liquidity analysis. Summary of the data is shown below. So When evaluating the liquidity of three potential customers, which one of the following conclusion is correct? So we here see here low debt to total asset is given, but we are not going to going to calculate the low debt to total assets because it's the liquidity. So liquidity analysis must be done here. High long term debts, not high long term debts. So this is incorrect option, and this is also incorrect option because we have to do the liquidity analysis, not something long term debt. So let us now calculate what they are asking. First they are asking the current ratio and AC test ratio. So current ratio, and the firm should note that's low current ratio, so AC test ratio. So now we have to calculate the current ratio and AC test ratio for all these three companies. So let us calculate these. So first it is F, we have G, and we have H. So we have to calculate the current ratio and AC test ratio. So you know how to calculate the current ratio. So now I will write down the amount. For current ratio, for it's 1.314, and current ratio for G it is 2.03, and current ratio for H it's 4.11. The AC test ratio for company F is 0.34, and for G it is 1.37, and for H it is 1.62. So now let us analyze the option. See, company F has the low current ratio. So low current ratio, company F is having the low current ratio. This is correct. So the firm should not accept company F has new customer. This is correct option because it is having the low current ratio. So the firm should not accept this as a new customer. Next, what we have left? We have left question number 26. What is this? A company uses the allowance method to account for credited losses. The accounts that an accounts receivable that was previously determined uncollectible and written off was collected during May. The effect of the collection on the company's current ratio and total working capital is. So let us take some numbers, existing and new. We have inventory that is existing, we had 100,000, and in the new also the inventory was 100,000. Now we have AR, accounts receivable. We had 100,000 of accounts receivable. Now we have allowance for uncollectible. Allowance for uncollectible we have 7,000. So what will be your total what we'll call accounts receivable? That is going to be 93,000. And your cash is 17,000. So your total assets or current assets is 210,000. Now here what happens, your inventory is 100,000, your accounts receivable is 100,000, but your allowance for credit is increased by 12,000. So this is going to decrease your AR, right? 88,000. So AR is decreased from 93,000 to 88,000, and your cash is going to increase. Your cash is going to increase to 22,000. So the net assets is to 10,000. So what happens? A company uses the allowance method to account for credit loss. Accounts receivable that was previously determined uncollectible were written off was collected during May. So when you are going to collect your accounts receivable, that you are going to debit your cash, and allowance for uncollectible account is going to be increase. So you are going to get cash 5,000, and that is 5,000. So what is going to happen with this? Your cash is going to increase by 5,000, so which will be 22,000, and your accounts, your this what we'll call allowance for uncollectible account is going to increase by 5,000. So that's from 7,000, it will increase to 12,000. That will decrease your account receivable to 88,000. So by this transaction, what is going to happen? Current ratio there will be none, and working capital is the difference between current assets and minus current liability. So there will be no change in working capital as well. Next we have 35. Okay. The financial assistant position mileage innovation as of September 31st of the current year as presented as follows. So we have cash, if we have accounts receivable, we have inventories, we have total current assets, accounts payable, accrued liabilities, and total current liabilities. The board of directors of Mileage Innovations met on October 4 of the current year and declared a regular quarterly dividend amounting to 750,000 0.6 per share. The dividend is payable on October 25 of the current year to all the shareholders of record of October 12 of the current year. Assume that only transactions to affect Mileage Innovations during October of the current year are the dividend transactions, and that the closing entries have been made. Mileage Innovations working capital. So working capital, we know that the working capital is the difference between current assets and current liabilities. So now let us understand what is the effect on the working capital. So there is a dividend declaration, right? The board of directors of Mileage Innovations met on October 4 of the current year and declared a regularly quarterly cash dividend. So cash dividend is being declared. So on October 4, Oct 4, what we are declaring, declaration is there. On October 4, we are declaring a cash dividend amounting 750,000. So what entry do we pass on the date of declaration is we are going to debit your retained earnings by 750,000, and we are going to credit the accounts payable by 750,000. Now this is on October 4. The dividend is payable on October 25 of the current year to all shareholders. So October 25 of the current year, payable on record as okay. So October 25, what we do on Oct 25, we are going to pay. Dividend is paid. So when we are going to pay the dividend, that is accounts, it's not accounts payable, or you can call it as dividends payable, or it's dividends payable by 750,000, that will be debited, and your cash is going to be credited by 750,000 when you are paying the dividend. So let us see, unchanged by the dividend declaration, current assets and current liabilities, no, it will decrease because your dividends payable means your current liabilities is increasing. Your current liabilities is increasing, this means your your working capital is going to decrease, and decrease by the dividend payment, no effect by the dividend payment. Why there is no effect? Because your cash your cash is decreasing and your accounts payable is decreasing. So your current assets decreases and your current liabilities is decreases, so there will be no effect on working capital. So what is the correct option? Decrease by dividend declaration, increase by dividend payment, no effect by dividend payment. Unchanged by dividend declaration or dividend payment, no. Decrease by the dividend declaration, by dividend declaration the working capital is going to decrease. And unchanged by the dividend payment, and it's unchanged by the dividend payment, then this is the correct option. Next, entries are same, so they are asking the effect on current ratio. So when you calculate the current ratio comes to greater than 1. So you know that current ratio is current assets by current liabilities. So current liabilities are given, and your current assets cash is your current assets, account receivable, inventory. So total current assets is given. So 5431 by 1789, that is greater than 1. So what happens here? This is only the transaction that is going to affect. So what is happening on the current ratio? So decrease by dividend declaration. See, retained earnings has no effect on current. So dividends payable is increased. Dividends payable is increased. This means the current ratio will decrease. Increase by dividend payment. It will increase by dividend. The current ratio will increase by dividend payment. Unchanged, no. Decrease by dividend declaration. It will decrease by the dividend declaration. And unchanged by dividend payment, no. It is unchanged by the dividend payment, no. It is going to increase by the dividend payment. So increase of this also increase. So the correct option is that it is going to decrease by the dividend declaration and increase by the dividend payment. So this is the correct option. So we have completed around this 52 MCQs. So let us finish our test. So we are standing at 100%. So let us return to the dashboard. Let us go to the MCQ section. No. Let us return to the dashboard. Let us go to the statistics section. So what we have done, we have completed the completed financial statement analysis 16 MCQs, and we are standing at 100%. We have completed the liquidity ratios. We have completed all 52 MCQs, and we are standing at 100%.